Hi everyone, in this lesson we will talk about the market structure. As a price action trader, it is very important for you to understand and master the market structure. And in this video, I'll show you the basic elements of market structure, such as uptrend and downtrend structures, range-bound structures, support and resistance structures, and retracement and impulsive move structures. When you understand these concepts, you will understand the market a lot better, and you will be able to spot what's going on with an instrument or a graph. So let's start with the first basic element, which is the market trend. So how to identify a trend? Traders come up with different ways to identify a trend. Some look at how moving averages are interacting with each other. Some look at indicators that have been specifically created to identify trends, and others, like me, prefer to look directly at the price action. The most basic way to identify a trend is to check and see if a market is making a pattern of higher highs and higher lows. When it comes to an uptrend, as you can see here, this is the first higher high and then the higher low, a higher high, followed by a higher low. These patterns help us determine the trend of the market. In this case, this is an uptrend, which means that buyers are in control of the market. Your ability to identify an uptrend market will help you determine which trading decision should you take, whether to buy or to sell. And in this case, to join this market, you should find a buying opportunity that is in line with the uptrend market. Let me show you a real chart example. As you can see here, the market is making higher highs and higher lows patterns, which indicates an uptrend. Let me show you another example. This is a clear uptrend, making clear higher highs and higher lows pattern. You shouldn't think too hard about whether a market is trending or not. Most traders make trend discovery way too difficult. Make it stupid simple. Just open your chart, as you can see here, and observe it. It is fairly obvious if a market is trending up or not. Now let's move to the opposite version of an uptrend market, which is the downtrend. So when prices make lower highs and lower lows, this is a clear indication of a downtrend. A downtrend indicates that sellers are in control of the market. Let me show you a real chart example. As you can see here, the market is making a lower high and a lower low, a lower high and a lower low, which show a clear downtrend. So here sellers are in control of the market. And if you want to join this trend, you should find a clear selling opportunity. You can't buy the market here because you will trade against sellers and lose money. So let's take this trading rule. If a market is making a pattern of higher highs and higher lows, it is then an uptrend. And in this trading condition, buyers are in control of the market. If a market is making a pattern of lower highs and lower lows, it is a downtrend. And in this trading condition, sellers are in control of the market. The third type of markets is the range-bound market. A range-bound market is one in which prices bounce in between a specific high price and low price. The high price acts as a major resistance level in which price can't seem to break through. Likewise, the low price acts as a major support level in which price can't seem to break as well. When the market ranges, it indicates a balance between sellers and buyers. So the market trades between horizontal support and resistance. And in this trading condition, you can't trade inside the range. You trade either from support or resistance levels. Let me show you a real chart example. As you can see in this chart, the market is trending up, making higher highs and higher lows. Right now, you know that buyers are in control of the market. Your ability to identify this uptrend will help you see who is in control of the market. And in this trading condition, it's obvious that buyers are in control of the market. So the best trading decision is to buy when there is a high probability setup. As you can see here, the market stopped making higher highs and higher lows. Instead, it started trading horizontally. So here you will change your way of thinking. Because buyers are no more in control of the market, buyers and sellers are equal, and the best trading decisions should be taken from the boundaries. I mean from support and resistance. Let me give you another chart example. As you can see here, this is a downtrend. The market is making lower highs and lower lows, followed by a range. Your trading decision here is completely different from yours here. In this trading condition, sellers are in control of the market. So the best trading decision will be to sell when there is an opportunity to join sellers. But here, we know that buyers and sellers are equal because the market ranges, and the best trading decision should be made from either support or resistance. Let's move to another important element of the market structure, which is support and resistance. One of the first things you have to learn as a price action trader is the concept of support and resistance levels. So what is support and resistance? Support and resistance are points in the market where the price has a high probability of reversing. Knowing where these levels form and the reason why they form can help you in predicting where the price is likely to reverse and start moving in the opposite direction. So how to identify support and resistance levels? In fact, there are specific criteria we look for to identify support and resistance levels, such as swing highs and swing lows. We look for swing highs and swing lows, meaning the highest and lowest points that prices has reached in recent time. The second trait is obvious price rejection point, and here we look for levels where prices are clearly rejected and reversed in the opposite direction. And the third trait is broken support levels that become resistance and broken resistance levels that become support. We don't really need all the criteria we just listed to mark a level of support and resistance, but the more criteria that the levels have, the better. Let's jump to the chart and break down each of these points. So let's start with the point number 1 that qualifies a level of support and resistance, which is the extreme swing highs and swing lows, meaning the highest and lowest point that price has reached in recent time. So we look left and we notice price came up, hit and reversed, and this was the highest point the price has reached, making it an extreme swing high, which represent a resistance level. Now same along the bottom, price came down, hit and reversed, and this was the lowest point the price got to in recent time, making this a level of support. As you can see, when prices reached this resistance level again, the market reversed in the opposite direction. It came down, hit the support level and reversed again. So here we can say that the market is trading between horizontal support and resistance levels. It doesn't matter how high or low price is. We never jump into trades blindly. We always wait for price action setups. The second trait that qualifies a support or resistance level is an obvious rejection point. Let me show you this example. As you can see here, price came up to this area and it was obviously rejected, giving us a level of resistance. Look at how the market moved down strongly after this rejection. So this area is considered as a resistance level because at this point, buyers were rejected by sellers and the market reversed. When the market comes back again to test this level, we can predict another strong move down. Look at what happened here. The market rejected again and respected the resistance level. And the same thing happened here again. So an obvious rejection point followed by a strong move down can help us identify a resistance level. The third trait that qualifies a support and resistance level is a broken support level that becomes resistance or a broken resistance level that becomes support. When the market forms a support level, prices respect this level. But when this level is broken, it becomes resistance. And when price pulls back to test it, here you should pay attention to this level because it becomes a reference point in the market. Let me show you an example. As you can see here, the market came up, hit and reversed, forming a resistance level. It came down, hit and reversed again in the opposite direction, forming a support level. And as you can see here, this is a clear rejection followed by a strong move up. And this is one of the points that we consider when identifying a support level. When price approached the resistance level, the market reversed, but prices didn't respect the support level. This breakout indicates that buyers are no more strong, because if they were more strong than sellers, the market would hit and goes in the opposite direction. So this support level will always be considered as an important reference point in the market. This support level becomes a resistance. And as you can see, after this breakout, the market hits the resistance level and goes down. Let's look at another example. As we note, the market came up, hit and reversed, forming a resistance level. When the market approached this level, prices didn't respect the resistance level, and it was broken, which indicates that buyers are more stronger than sellers. But this level will be considered as a reference point and becomes support. And as you can see, the market pulls back to the resistance that becomes support and goes up. Support and resistance are easy to spot on your chart. Don't make too much effort to identify these levels, because the most important ones are obvious, and with screen time and practice, you will find them easily on your chart. Just remember the 3 traits that help us identify a level of support or a resistance, which are an extreme swing high or an extreme swing low, an obvious rejection point followed by a strong move up or a strong move down, a broken support level that becomes a resistance, or a broken resistance level that becomes support. Another component of the market structure is the impulsive and corrective move. So what is an impulsive and a corrective move? An impulsive move is one whereby the market moves quite strongly or heavily in one direction, covering a great distance in a short period of time. They are generally more volatile and provide us with a great opportunity to get more reward with less risk, since the market will stretch more easily in one direction. A corrective move, also called correction, retracement, or a pullback, is a movement against the main trend. They are formed if traders trade in the direction of the main trend close their position. So how to identify and predict impulsive and corrective moves? First of all, you have to be able to identify the trend. In other words, the direction of the trend. I have talked previously about how to identify an uptrend or a downtrend. As you know, an uptrend market is characterized by series of higher highs and higher lows, and a downtrend is characterized by series of lower highs and lower lows. So don't complicate your analysis. An uptrend or a downtrend is obvious. If you feel like you're confused and you don't know if the market is trending up or trending down, ignore that chart and move on. Look for a chart where the market trend is clear. Identifying the market trend is very important, because during an uptrend or a downtrend, prices make 2 distinctive moves: an impulsive move in the direction of the trend and a corrective move against the trend. Let me show you a real chart example. As you can see here, this is an obvious uptrend. In an uptrend market, buyers are in control. This market is characterized by 2 important moves that you should know and understand. The first move is an impulsive move, as you can see here, followed by a corrective move, and another impulsive move, followed by a corrective move, and another impulsive move. This is how an uptrend market moves. If you want to make money trading any financial market, you should ride the impulsive move and avoid being trapped in a corrective move. So how do corrective moves and impulsive move form in the market? In this real chart example here, buyers placed numerous amounts of orders, so the market goes up, forming an impulsive move. As you can see here, when they closed their positions and took profit, the market goes down a little bit, forming a corrective move. The same scenario happens here. Buyers placed numerous buy orders here. As a result, the market goes up. But here they closed their position, took their profit, and as a result, the market goes down, forming a corrective move. This scenario will happen over and over again till the end of this uptrend. So this is how an uptrend market moves. Your job as a price action trader is to identify the beginning of an impulsive move, because the most profitable buy signals are found at the end of corrective moves and at the beginning of impulsive move. To predict the end of a corrective move and the beginning of an impulsive move, we use support and resistance levels. Look at the chart again. As you can see, this is an impulsive move. Look left. Here there is a resistance level. The impulsive move breaks the resistance level, so when the impulsive move ends, the market will make a corrective move, or what we call a pullback or retracement. So when the market reaches the resistance that becomes support, we can predict the beginning of a new impulsive move formed at the support level. The same scenario happened here. Breakout of the resistance, a pullback, and a new impulsive move forms at the support level. So this is how we can predict the beginning of an impulsive move by using support and resistance levels in an uptrend market. Let me give you another example. As you can see here, this is a daily chart. The market is trending up. This is an impulsive move followed by a corrective move. Look left. This is a resistance that will be used as a reference point for buyers to make another impulsive move. This is another impulsive move, the breakout of the resistance level that becomes support, a pullback or a corrective move, and another impulsive move. This is the most important move because, as you can see, when the market reaches the resistance level that becomes support, which is a reference point for buyers, we can predict the beginning of a new impulsive move. And as you can see, this is an engulfing bar signal that indicates the beginning of an impulsive move. Look at another example of an uptrend market. An impulsive move followed by a corrective move. Look left, a resistance level that becomes support. This is a reference point for buyers, and when the market reaches this level, we can see a clear signal of an engulfing bar that indicates the beginning of a new impulsive move. The same thing happened here. This corrective move formed the resistance that becomes support, and when the market reached this level, another impulsive move took place. For a downtrend market, sellers are in control. A downtrend market can have also two distinctive moves, an impulsive move and a corrective move. Let me show you an example. As you can see here, this is an impulsive move. Look left. This is a support level that becomes resistance, and this level is a reference point for sellers. When the market approaches this level, after this corrective move, sellers will make another impulsive move. And as you can see, this is a clear pin bar that was formed at the resistance to indicate the beginning of a new impulsive move. This is another example of a downtrend. As you can see, an impulsive move here, a breakout of the previous support that becomes resistance. This level is a reference point for sellers. When this corrective move approaches this level, we can predict the beginning of a new impulsive move. The same thing happened here. The breakout of the previous support that becomes resistance, a corrective move, and when this corrective move reaches this reference point, the resistance level, we can predict the beginning of an impulsive move.